Throughout recent decades, a repeated pattern has systematically wiped out the life savings of millions, and by 2025, the legal structures needed for such events are firmly in place within the United States. In 2013, Cyprus unexpectedly closed its banks, and when they reopened, nearly half of deposits exceeding €100,000 had vanished, not stolen, but confiscated by government decree to prop up banking institutions on the brink of failure. Similarly, in 2015, Greece imposed strict capital controls. Citizens could only withdraw €60 daily from their accounts. Their funds were effectively locked away, inaccessible for months, with no ability to transfer or leave the country with their money. By 2019, Lebanon's banking system had frozen all accounts, capping withdrawals at a mere $200 per week, an illegality that persists 6 years later, leaving wealth tied up and essentially lost in a failing system. These crises, 9 developed nations, 3 pivotal moments, highlight that governments have repeatedly, legally, seized depositors' funds, not through taxes or inflation, but directly from individual accounts. What should truly alarm anyone is that the simplistic yet powerful legal mechanism to execute such seizures already exists in the U.S. since 2010, embedded within the Dodd-Frank Act. It's known as bail-in authority. Under looming financial distress, your deposits are targeted first, before any government funds or Federal Reserve loans come into play. The story is about how modern governments can legally confiscate bank deposits, why such laws are in place, and why the safety of personal savings is more fragile than it appears. Understanding what a bail-in entails is crucial. Unlike previous bailouts, where taxpayers' money was used to save banks, a bail-in involves the bank turning to its depositors, your savings, and converting those deposits into bank equity when the bank is insolvent. It's a legal process already carried out thrice, transforming your safe deposit into shaky equity, and doing so overnight, without prior warning or consent. Take the first major example, Cyprus, March 2013. A small island with a population just over 1 million, Cyprus had become a regional banking hub, attracting foreign wealth due to low taxes and banking secrecy. By 2012, the nation's banking assets soared to over 8 times its gross domestic product, largely invested in Greek bonds. When Greece's debt crisis erupted, those bonds plummeted, leaving Cyprus's largest banks insolvent with losses exceeding their capital reserves. Their failure was hidden behind a facade of selective accounting, until early 2013, when an upcoming need for a bailout forced the EU and IMF to demand a terrifying solution. Depositors would have to bear the burden, losing a significant portion of their savings through a stability levy, a euphemism for seizing their funds. To prevent chaos, the banks closed suddenly on a Saturday and reopened almost 2 weeks later with capital controls, restrictions on withdrawing or transferring money, effectively trapping savings. 2 years later, Greece faced a similar crisis. Years of austerity, unemployment, and economic contraction culminated in a collapse of confidence. When Greek banks imposed strict withdrawal limits, restricting citizens to a paltry €60 daily, they seized the very notion of accessible savings. Though technically no deposits were directly confiscated via bail-in, the restrictions rendered funds practically unusable, trapped, inaccessible, and devalued. This pattern of bank failure, containment, and eventual collapse was a stark warning. Governments can engineer the trapping or seizure of savings for years, eroding trust permanently. Lebanon's ongoing crisis illustrates a yet darker potential. Once called the Switzerland of the Middle East, Lebanon's banking system was a pillar of stability until multiple signs of systemic fraud emerged. Freed from the dollar peg established in 1997 and burdened with massive public debt and Ponzi-like dependence on new deposits, their financial house of cards began collapsing by 2019. Desperate depositors, seeing their savings vanish as the government defaulted and currency values plunged, resorted to protests, bank runs, and even armed attempts to access their funds. The government's response, freezing accounts and limiting withdrawals, made those savings effectively inaccessible and worthless, forever altering the relationship between individuals and their bank accounts. In every case, Cyprus, Greece, Lebanon, a clear, legal framework was exploited to seize or mire depositor funds, eroding trust and permanently undermining the concept of safekeeping deposits. The pattern is unmistakable. A bank becomes too large relative to the economy. Reckless or risky investments are made. An economic or political shock exposes the fragility. Depositors try to withdraw their money. And, at the height of crisis, authorities intervene, either outright seizing assets, imposing controls, or freezing accounts, transforming actual savings into inaccessible or worthless claims. The warning signs are already apparent inside the United States. The federal law, specifically Section 206 of Dodd-Frank, grants regulators the authority, should a systemic crisis emerge, to execute bail-ins by converting deposits into equity. This means, if the next major crisis hits, fueled by burgeoning unrealized losses on regional banks, collapsing commercial real estate, or a financial riposte, the safety of your savings might evaporate overnight. Historically, moments of stress have shown how quickly trust erodes. Silicon Valley Bank, for instance, suffered a sudden withdrawal of over 25% of its deposits in a single day, leading to its failure. Furthermore, the infrastructure for digital bank runs accelerates this risk exponentially. Transfers and withdrawals that once took days can now be completed in seconds via smartphone apps, unleashing chaos in moments. Meanwhile, the federal safety net, FDIC deposit insurance, offers a fraction of total insured deposits, and even that safety net is only meaningful if not overwhelmed during simultaneous bank failures. In reality, most deposits, over $18 trillion, are either uninsured or vulnerable to seizure in a widespread crisis. The legal authority to execute bail-ins exists now, waiting in the wings. In a crisis, governments could swiftly impose capital controls, freeze accounts, or convert deposits into shares of failing banks, modeling after past examples, inflicting irreparable damage on personal savings and economic stability. The pattern of history, from Cyprus to Greece to Lebanon, serves as a stark warning. Trust in the safety of bank deposits can vanish in an instant. To safeguard oneself, it's vital to recognize that deposit funds are loans to banks, unsecured, and at risk in insolvency. Diversify deposits, avoid keeping more than the insured limit in any one bank, and hold some cash physically outside the financial system. Investing in tangible assets like gold or real estate offers an alternative hedge. Prepare a plan, know where and how to act if controls or seizures are announced, and understand that governments will prioritize the system over individual savings. After all, the law already provides the authority, and past experience demonstrates that, in a crisis, your money can very well become someone else's equity or simply disappear for years. The time to act is now. While signs of vulnerability grow, the pattern is clear, and history's lessons are unambiguous. The question is whether you will recognize the threat in time, or be caught unprepared when your savings become unreachable. When the next crisis hits, understanding what has happened before will be crucial. In the early 2000s, Cyprus emerged as a hub for banking, attracting Russian oligarchs, European firms, and wealthy individuals seeking refuge. The allure lay in favorable tax policies, high levels of banking secrecy, and close access to the Eurozone. By 2012, the Cypriot banking system's assets soared to a staggering 800% of the nation's gross domestic product, with the largest banks, the Bank of Cyprus and Laiki Bank, growing dangerously powerful and laden with risky investments. Their downfall was linked to Greek government bonds, which offered attractive yields between 10 and 12%. Eager for high returns, Cypriot banks invested heavily. But when Greece's debt crisis erupted between 2010 and 2012, those bonds plummeted in value, forcing Greece to restructure its debt and impose losses of 50 to 70% on bondholders. Banks holding billions of Greek bonds suddenly found themselves insolvent, their losses exceeding their capital reserves, effectively bankrupt. Yet, they remained operational, as everyone chose to ignore the mounting losses, a game of pretend, where marking to market was avoided to conceal failures. By early 2013, the facade crumbled. The banks required a bailout, needing around $10 billion to recapitalize, an amount Cyprus's entire $18 billion economy couldn't support. Desperate, Cyprus turned to the European Union and IMF for aid. The EU agreed, but with a grim stipulation: depositors had to be looted to stabilize the banks. On a Saturday, March 16, 2013, banks shut without warning. ATMs were disabled, branches sealed, and the government announced a one-time stability levy on all deposits. Almost 2 weeks later, on March 28, they reopened, but strict capital controls prohibited large transfers. That is, your money was locked inside the country. Fast forward 2 years to Greece's turmoil in the summer of 2015. Years of austerity, GDP down a quarter, and unemployment soaring to 25%, failed to quell the debt crisis. Negotiations with European lenders broke down in June, and Greece faced default. Knowing what might happen, Greeks rushed to withdraw their savings. Within a week, over $8 billion were drained from Greek banks. Bank runs had begun. By late June, the Prime Minister announced a referendum on the bailout terms and closed the banks suddenly, first for a day, then for 3 weeks. When they finally reopened, strict capital controls were enforced. Greeks could withdraw a mere $60 daily from ATMs, or $120 weekly if using a branch. Cruel limitations for those relying on pension withdrawals or everyday expenses. Imagine the hardship: waiting in scorching heat, hoping to access just enough to survive another day, while the country's economy hung in the balance. That was the harsh reality. International wire transfers were forbidden. Businesses couldn't pay foreign suppliers, nor could they import goods or send money to family abroad. The economy shifted to a cash-only system because there was simply not enough money circulating. Greece, unlike Cyprus, didn't seize a portion of deposits through a bail-in. Instead, they chose a process arguably even worse. They trapped the money, rendering it unusable. If access to your savings was cut off, and you could only withdraw $60 a day, did you truly possess that money? Practically, it was confiscated. The balance remained visible in your account, but you couldn't access or use it. It became trapped. These capital controls persisted until 2019, lasting 4 years. Even after their removal, the lesson was clear: distrust the banks. Many Greeks learned the hard way, withdrawing cash from their homes or moving funds abroad whenever possible. Today, bank deposits in Greece have not returned to their 2909 levels, 16 years later, because once trust erodes, it never fully recovers. Greece demonstrated that even without a formal bail-in, governments can trap your money indefinitely, making it inaccessible and practically worthless, especially over lengthy periods. Cyprus was a small nation, struggling economically, so perhaps it was only in crisis-hit countries that such measures are employed. But Lebanon proved otherwise. Starting in 2019, this crisis remains ongoing, and it might be worse than all others combined. For decades, Lebanon was known as the Switzerland of the Middle East, a financial hub with respected banks and a stable Lebanese pound pegged to the US dollar at approximately 1,500 to 1,200. The banking sector's assets soared to around 400% of the nation's GDP by 2019. Yet, beneath the surface, it was essentially a Ponzi scheme. The government ran massive deficits, ranging from 10 to 15% of GDP annually, and banks bought government bonds paying between 8 and 12% interest. Where did these banks get the money to buy such bonds? From depositors, both Lebanese citizens and foreigners, who deposited dollars because of the high interest rates. The banks used these deposits to purchase government bonds, operating smoothly, so long as new deposits kept flowing in. But this was fundamentally a Ponzi structure, relying on continually replenishing deposits to pay off existing ones and fund government spending. When 2019 arrived, cracks appeared. The government could no longer borrow. International lenders ceased funding. Foreign exchange reserves dwindled, and depositors grew wary. Protests erupted in October 2019, sparked by new taxes and economic hardship. Quietly, a bank run began. People sought to withdraw dollars, but the banks had lent much of those dollars to a government that had already spent them. By November 2019, deposit limits were imposed, initially informal and later formal, starting with $1,000 weekly. The restrictions became more severe, and cash withdrawals were reduced further, leaving many unable to access their savings. Despite the official limits, account statements continued to show full balances, giving a false sense of security. Yet in truth, The money was inaccessible, trapped by the collapse of confidence and a failing financial system. In Lebanon, 2022 saw a dramatic escalation, with people resorting to extreme measures to access their own funds. The government had defaulted on its debt in 2020, rendering the nation's currency virtually worthless. Despite their accounts showing substantial balances, depositors found themselves unable to withdraw their money amid ongoing restrictions that had been in place for 6 years. Some responded with lawsuits. Others, driven to desperation, stormed banks armed, attempting to seize their savings by force. Hostage situations arose, with individuals even holding bank employees at gunpoint to retrieve their own money. In 2022, a man famously held up a bank with a firearm, demanding $5,000 for his father's medical expenses, earning himself the title of a folk hero because across Lebanon, many were caught in the same plight. The core lesson from Lebanon is that modern banking fundamentally relies on public confidence. Once that trust erodes, banks can simply refuse to release deposits, and the government's role diminishes. Courts can neither compel access nor recover lost funds, for the money has vanished, lent to an insolvent state or squandered through reckless investments. In every case, Cyprus, Greece, Lebanon, the outcome is eerily similar. Depositors lose access to their savings through different legal mechanisms. Cyprus's direct bail-in saw nearly half their deposits seized and converted into worthless shares. Greece imposed strict capital controls, confining withdrawals to a paltry $60 daily. Lebanon's informal freeze made funds visible yet inaccessible. Each scenario shattered the illusion of safety, yet all were executed within the bounds of legality, or at least went unpunished. A pattern emerges, one that repeats consistently, a warning sign nations and individuals alike must heed. The first stage is an overextended banking system. Cyprus's banks amassed assets totaling 8 times its GDP. Greece's, 300%, Lebanon's, 400%. When the banking sector swells far beyond the economy's capacity, insolvency becomes unavoidable. In the United States, the 6 largest banks hold assets exceeding $12 trillion, nearly half of the entire national GDP, and their simultaneous failure would overwhelm any bailout. Next, banks tend to indulge in risky ventures. Cyprus's banks bought Greek bonds that later collapsed. Greece's government defaulted after borrowing excessively. Lebanon became a Ponzi scheme with public debt. Banks thrive on risks, reaping profits during good times while relying on bailouts when difficulties emerge, creating a moral hazard. U.S. banks currently hold $500 billion in unrealized bond losses, while collapsing commercial real estate signifies mounting systemic peril. Failures such as Silicon Valley Bank, Signature Bank, and First Republic Bank during 2023 serve as ominous warnings. The third stage exposes the underlying vulnerabilities, crises that reveal losses too significant to hide. Cyprus experienced a debt restructuring, Greece defaulted, Lebanon's government ran out of foreign currency reserves. In each instance, something triggered the exposure of bank losses, rendering them undeniable. The culmination involves panic-driven bank runs or enforced measures. These events threaten to escalate the crisis, especially in a fragile financial ecosystem on the brink of systemic failure. In the United States, a recession, a collapse in commercial real estate, rising interest rates exposing bond losses, or a geopolitical crisis triggering a dollar flight could all serve as catalysts. Yet, the specific trigger isn't crucial. The vulnerabilities are already in place. We are now at stage 4, bank runs. Once depositors recognize the danger, their natural instinct is to withdraw their funds quickly. In a fractional reserve banking system, banks typically hold only about 10% of deposits as reserves, with the remainder lent out. If everyone attempts to retrieve their money simultaneously, the bank cannot withstand the pressure and will fail. Historically, bank runs either commenced or hovered close to happening when governments intervened. Between 2020 and 2023, in the United States, numerous banking crises unfolded, exemplified by Silicon Valley Bank, which faced $42 billion in withdrawals within a single day before regulators shut it down. The advent of digital banking, where funds can be moved instantly via phone apps, has accelerated the speed and severity of these crises to an unprecedented level. We are now at stage 5, government intervention. Authorities often step in to stave off widespread collapse, yet such actions invariably come at a cost, ultimately borne by depositors. As seen in Cyprus, deposit seizures, bail-ins, Greece's capital controls trapping funds, and Lebanon's indefinite and formal freezes have set precedents. In the United States, existing laws already authorize similar measures. For example, Section 206 of the Dodd-Frank Act grants the FDIC authority to resolve failing banks by converting deposits into equity, effectively turning your savings into stock in a distressed institution. Though this legal framework is on the books, it remains in use thus far. The final stage involves prolonged economic hardship. Even after a crisis is contained, its aftermath endures. Cyprus took years to recover, Greece continues to grapple with the fallout, and Lebanon faces humanitarian and economic turmoil. Once trust in banking systems erodes, it often never fully restores. People withdraw cash, businesses halt credit expansion, investments dry up, and economic growth stalls. That is the familiar pattern, 6 stages in total, and the United States has already experienced the first 4. Currently, we are in stage 5, with the next large banking crisis approaching. Vulnerabilities are evident in several areas. First, many regional banks are saddled with unrealized losses. When the Federal Reserve accelerated interest rate hikes from near 0 to 5% in 2022 and 2023, bond values plummeted. Banks, holding trillions in bonds, now possess assets worth far less than their purchase price. Under current accounting rules, these losses aren't recognized unless the bonds are sold. Yet if depositors rush to withdraw funds, banks must liquidate assets at a loss, further diminishing their capital. Silicon Valley Bank exemplified this, with $16 billion in unrealized losses. When withdrawals surged, they had to sell bonds at a loss, ultimately leading to bankruptcy. Numerous other regional banks face similar risks. Second, the commercial real estate sector is vulnerable. Office buildings have lost 40 to 50% of their value since 2019 due to widespread remote work trends. Yet many banks continue to lend against 2019 valuations, exposing them to significant losses if these properties are liquidated or refinanced at current values. Currently, U.S. banks are exposed to over $3 trillion in commercial real estate loans. When these properties are refinanced or sold at current market values, banks face significant losses. For instance, early in 2024, New York Community Bank nearly collapsed due to its heavy exposure to this sector. They aren't alone. Moreover, FDIC insurance serves more as a myth than a safeguard. Its funds amount to about $125 billion, but with total insured deposits nearing $10 trillion. Only a mere 1.25% coverage. It's clear that if just 2% of banks fail, the insurance fund would be exhausted. The reality is even grimmer, with over $18 trillion in total deposits, most of which are uninsured. Depositors holding more than $250,000 in a single bank face losing everything beyond that threshold. Even those with less are vulnerable. If multiple banks fail simultaneously, the FDIC doesn't have enough to cover all losses and must resort to borrowing from the Treasury or the Federal Reserve, effectively printing more money, leading directly to inflation. The harsh reality is that depositors either lose their savings outright or see their value eroded through inflation, an impossible choice. The prospect of digital bank runs further complicates the picture. Unlike in the past, where withdrawing money involved waiting in lines, today, an individual can transfer $50,000 or more with a few taps on a smartphone within seconds. They can move funds to another bank or convert them into Bitcoin. Just recently, Silicon Valley Bank witnessed a staggering $42 billion, about a quarter of its total deposits, withdrawn in a single day, and that was just within 24 hours. Such rapid withdrawals are impossible for any bank to withstand. Once one bank falters, social media spreads panic instantly, prompting mass withdrawals from other institutions. This creates a domino effect that leads to collapse. The legal framework for such collapses is already in place. Under the Dodd-Frank Act, specifically Section 206, the Federal Deposit Insurance Corporation can resolve failing banks through a bail-in, converting depositors' funds into bank equity during systemic crises. Imagine a scenario in late 2025 or 2026, an economic downturn with rising unemployment, widespread corporate defaults, and failing commercial real estate loans. When a regional bank announces heavy losses, depositors panic and rush to withdraw their funds. The bank fails, and the FDIC steps in, but its resources quickly run dry as other banks with similar risks face runs. Within a week, multiple failures occur, the stock market plunges by a fifth, and credit markets seize up. In response, authorities impose capital controls, limiting ATM withdrawals to a few $100s daily, restricting international transfers, and instructing that deposits over $250,000 be converted into bank shares. For example, if you had a $500,000 deposit, only the insured portion would be safe. The other half could be transformed into shares worth pennies on the dollar. This pattern has repeated across 3 nations, Cyprus, Greece, and Lebanon, each demonstrating that in times of crisis, what you believe is your money is actually an unsecured loan to the bank, subject to being converted into ownership stakes or frozen indefinitely. From Cyprus's bail-ins to Greece's prolonged capital controls and Lebanon's indefinite deposit freezes, the message is clear and consistent. Bank deposits are not as secure as they seem. The law already grants authorities the power to execute these actions, and vulnerabilities continue to grow. This reality suggests that a banking crisis on a similar or even larger scale may be imminent. Be aware, in such crises, the government will prioritize saving the system, even if it means taking your savings without notice. Recognize that depositors are increasingly vulnerable, and the safety of your savings depends on understanding these potential risks and preparing accordingly. And if this insight resonates with you, consider staying informed to navigate the coming challenges effectively. Lebanon demonstrated how banks can simply refuse to release your funds, with no recourse for the depositor. The United States already has the legal mechanisms, both bail-ins and capital controls, in place for such scenarios. The risks are severe, warning signs are everywhere, and patterns from history indicate that these events are inevitable. Perhaps it's a matter of months, a year, or 2, but the mathematics of the system makes collapse unavoidable. What steps should you take? First, recognize that your bank deposits are not savings. They are unsecured loans to the bank. If the bank fails, you become a creditor, and creditors absorb losses. Second, avoid putting all your money in a single bank. Do not keep more than $250,000 in one institution. Spread your wealth across several. Third, retain physical cash outside the banking system because, if capital controls or bail-ins are implemented, cash in hand becomes your primary accessible resource. Fourth, consider investing in tangible assets, real estate, gold, or other commodities that exist independently of the banking system and cannot be frozen or seized. Fifth, develop a plan. Know what steps you'll take if restrictions are announced, where you'll move your funds, and what assets you'll acquire, because once the crisis begins, there will be no time to strategize. Finally, understand that the government's primary goal is to preserve the system and protect the banks, not the individual depositor. They will, if necessary, take your money. Cyprus, Greece, and Lebanon each demonstrated this reality. The law in the United States already permits such actions. When the next crisis unfolds, it will happen. In just 12 years, governments have legally seized depositors' funds 3 times. Each time, people believed they were safe, each time convinced it couldn't happen to them, and each time, they were proven wrong. The pattern is unmistakable. The legal frameworks are in place, the vulnerabilities are glaring, and history leaves no doubt about what will happen next. The only question is whether you will recognize the signs before your funds are frozen or confiscated. If this has opened your eyes to what's truly coming, stay informed. When the next financial crisis erupts, understanding what occurred and why will be crucial. The answers aren't in the future, they are written in the lessons of the past, and I will guide you on where to find them.